look like for risk management strategies for you? What happens if your family today goes through a lawsuit, a bankruptcy, a divorce, a major medical event? People have heart attacks, people have cancers. And I'm going to talk a little bit more about that as our time goes along. On the agenda today, I've got several things, and we're going to fly through a set of information here, but in just a moment, I'm going to hold up, there's going to be a slide that's going to help you with a QR code, and there's a free download. Everything we're talking about here today is free, and if you want a copy of my slide deck, just email us at the very end of here. There's an email that you can email my team, and you can get a copy of that free slide deck today. And you can take it back, and you can build your team with it. So today we're going to talk about succession planning and transition planning. How do you do that with the next generation and no next generation? We're going to talk about retirement planning. How do you keep more of what you make? Fire the IRS. We're going to talk a little bit about some of those risk management strategies, things that keep people awake at night for things like nursing home. The nursing home is a massive issue for many people when you start looking at $10,000, $12,000, $15,000 a month is what people are paying for long-term care expenses today. And I'll talk about some options that are available for you right now today that you can start using with your family, with your team, things that you can talk about with your kids. Now, here's the most important question I'm going to ask you today as you're sitting here in this room. When was the last time your accountant, attorney, financial advisor, insurance guy, loan officer, your people got in the same room and talked about your plan? When's the last time that happened? Because if you're running an active farm or ranch today, I would share with you that this is much like going to Mayo Clinic. Anybody been to Mayo Clinic here? Have you been to Mayo Clinic? Yep, me too. I spent 3 months there with my fiance when he was dying of cancer in 2016. And every single day, this Mayo Clinic team would walk in. And you had the whole team, from the social worker to the charge nurse to the oncologist to the radiologist to the drug people. I can't forget what their name is. The drug people, they hand you all the drugs. It's great. They're great people. I got to know them well. But that team through Mayo Clinic, the experience we had was every day they came in, they wrapped their arms around us and they said, "How can we help you? How can we take you from here to there?" Making sure that your team comes together is one of the things that my team does. So we come alongside your families, we come alongside your advisors in your hometown, because the problem is this. The same guy that does the county divorces and also does the land sales and also does the DUIs in your county is the same guy who's drafting your estate planning documents. And I don't want a local medical doctor doing my heart surgery. So when you think about going in for a cardiologist today, if you had to clean out your ticker, you know what I'm talking about, your ticker, right? You have some heart problems, we got a widowmaker about to happen, and we got to clean out the ticker. You don't watch a YouTube video and then decide to do your own surgery, right? But every day we do this with finance, and we do it on our farms, and we do it on our ranches every single day. And so our team comes in and we say, hey, let's bring those advisors into the table at the same time with you, with your family, and let's make a plan to figure out how do we get from here to there. Now, the reason I'm talking about this plan is because when you start looking at some of the statistics that we have right now out there, 70% of farm families that this is nationwide. We have clients in 43 states, by the way, 43 states. My home state is North Dakota. Minot, Bismarck, Jamestown. Today, we've got boots on the ground in these towns to help people make good decisions. Sit across the kitchen table from you and help you do that. But 70% of the people that we're talking to nationwide in agriculture today, 70% say, yep, we want to pass our farm and ranch on to the next generation. We expect to continue this as a family business, but only 25% of them have plans in place to do that, have a formal succession plan in place to do that. 72% of women are nursing home residents. So ladies, it ain't our hubbies, it's us. 72%. Now, of that 72%, gentlemen, I will just share with you, if you make it to a nursing home, you got good odds of getting a date, okay? I know, that was funny. That was compliments of my dad, who last year said, hey, the dating is good in a nursing home. I said, Dad, please don't tell me that again. I don't want to know. But, you know, when you start looking at some of the statistics, very few people, only 40% of you, even in a crowd, If online, doesn't matter where you're at, doesn't matter where in the country, only 40% of people have their estate plan coordinated today, actually have a will in place. So why is that? Well, here's some of the reasons. We don't know what to do. You know how to get in and market your grain. You know how to run that field. You know how to make sure that you're putting on whatever chemicals you're putting on at the exact same time. You know what to do when you're farming and ranching. And sometimes you go, man, I don't feel like I know what to do even then. But in this case here, when you do estate planning, succession planning, this type of transition planning, unfortunately, you do it once most of the time. And so we don't have a team. We don't know what questions to ask. We have family fights. And so there's a lot of things that are the enemy of your plan coming together for you. And so if you take that enemy and you say, hey, when the vision is clear, the decisions are easy, we can communicate properly with our families. We can make a decision to say, this is the best way for our kids and our grandkids to not only continue to farm, but also make sure that as they continue to farm, that the next generation eats dinner together at the family table on Thanksgiving and Christmas. I spend more time with my team talking through communication and what we call level 10 communication than anything else. How do we communicate it in such a way where your sons and daughters come together at the kitchen table when you're gone and they're not fighting over the will? There was an old plaque that I saw on the wall in a gas station one time, and it said, where there's a will, there's a family fighting over it. I think that's a shame. I think that's the place exactly where we need to be in that moment to determine what is your vision for your family, for your future, for your legacy. Because the legacy is far more than land. It is the people that you leave behind. Now, when you have the vision and the vision is clear, then the plan is the next step. So you decide, this is what I want to have and do and what I want it to look like. And that's a process that doesn't happen overnight. And you say, well, I want my kid to farm and I want my grandkids to farm and I want to be able to do that. If you want to be able to do that, the middle of that is the plan that you put in place. And it's going to involve these 4 things. So as you're following along, you want to write these 4 things down. You want to ask your advisors about them. What's my tax plan? What's my legal plan? What's my retirement and wealth management plan? What's my risk management plan? What happens if I get sick or hurt, I need a nursing home, or one of my kids goes through a lawsuit, a bankruptcy, or divorce? Now, I blew a whole lot at you, so hopefully you can watch this on YouTube later. Because there's a lot here. But this is the legacy at the end of the day. The plan leads to the legacy, and the plan leads to the steps of what do we need to do to make that happen. So the first thing I always ask people is, where are you now? This is a general assessment. So when you're looking at this is a general assessment. It's inside of here. It's all the questions that you want to make sure you answer and know the answers to for your family. So when you take that general assessment, we're not going to take you all the way through this. This is what I call homework. Homework. We got to do some work in the home to make sure that our work comes to fruition for our legacy plan. So you can take that home, take that general assessment, and it's going to take you through some very powerful questions that you need to ask your team. You need to ask the people that are working with you each day. Now, up here, you're going to see this fancy little thing called what the heck's this thing called again, guys? QR code. QR code. I know, I'm old school. I've been doing this 30 years. It's a long time. We used to just use paper and pens. Now we use this thing with our cameras and our phone. So if you hold your camera, if you're watching online or at a different time, if you hold your camera right up to the screen and click the camera button on it, it's going to lead you to a page. You're going to put in your email address, and when you put in your email address, this is going to end up in your inbox today, like within a few minutes. And that inbox is going to give you all the assessments and all of the planning hacks and all the tools that I'm going to give you here in just a few minutes. So you want to make sure that you get this QR code today, and you can email us any questions that you have after that's showed up inside your email box. Now, we got a lot of information to blow through in a very, very short period of time, so we're going to run. Who's with me? Who's ready? Okay, all in favor say aye. Aye, let's go. All right, so we're going to talk about the first set, which is how do we protect and preserve your assets. Now, one of the things that keep people out, I always start with this one because it's the worst one. This is the worst one. Nobody ever wants to talk about nursing home. No one wants to talk about long-term care. No one wants to talk about those things because they're scary. And they keep us up at night, and we think to ourselves, well, how would I pay for those things if I got sick or hurt? How would I pay for mom if she's there for 10 years or for 20 years? I've had people with dementia, with Alzheimer's. Their families need plans. We need help in this area. We need real tools and real information. So the very first step I'm going to give you is there are 5 ways to pay for long-term care. 5 ways. So when you think about long-term care today, you're going to think about assisted living care, in-home health care, full-blown nursing home care, and adult daycare. Now, adult daycare is more for like big cities and fancy people. Now, some smaller towns have those, but very, very few that I've seen. This is where you drop off your loved one at the day, and then you pick them up at the end of your day and bring them home, and they live with you at night. That's adult daycare. The other ones we're really familiar with: assisted living care, full-blown nursing home care, and in-home health care. In-home health care means they come to you and take care of you. There are 5 ways to pay for long-term care. So I'm not going to go through this in any order of importance, but I'm just going to give it to you. The first one is that you can pay for it out of pocket. Average cost right now in this area is about $10,000 to $12,000 per month for full-blown nursing home care. Average cost is anywhere between $4,000 to $6,500 if you are utilizing assisted living care. Now, my dad, who was in assisted living care, 91 years old, passed away last year. Hey, Dad, how's it going in heaven? When he passed, it was $6,800 is what we were paying. But I had medication services, I had clothing services, I had laundry services, I had cleaning services. That were all of his meals. It was everything, everything, everything. And people say, geez, that's a lot of money. What does it cost you to live when you look at your budget, right? What does it cost you to live? So of those 5 ways to pay, you want to understand what are your options today. So one of the first ways that you can pay for out of pocket with cash. Now, how long will that last? Well, how long will you be there? Did anyone bring their crystal ball to work that works today? Yeah, no one, right? No one's got a crystal ball to tell you how long you'll be there or what that'll look like. So when my dad went in, and this was my former father-in-law, got divorced many years ago, I kept the dad. It worked out good. Some people keep the land. I kept the dad. It worked out better for me. But he was an amazing man, and I shared with him many strategies to help him keep what he had lived and worked for a lifetime to build. Now, one of the things that we did is we created some options through this list of things that you could do today. So you can utilize a hybrid life insurance policy. This is a life insurance with a long-term care rider. I'm going to talk about that more in a minute. You can use traditional long-term care insurance. You can gift away your assets. That means there's a 5-year look back. When I say gift away, you literally gift them. You write a check or you do a quit claim deed and transfer the assets to those folks. You do a title transfer to whoever you're going to give that benefit to. Now, when you do that, that's great, but now you don't own it. So what are you going to live off of? So you got to think through those process with your planning team, those people that I talked about, your accountant, your attorney, your financial advisor, your insurance people, your loan officers, all those people that need to get in the same room and make sure that they're giving you advice, which, by the way, you're already paying for. Are you not? Does your lawyer ever not bill you? Does your accountant ever not bill you? Does your professional, do they just let you do it through the banks for free today? No, they do not. So if you're already paying for advice, let's put them around the same table and let's say, hey guys, weigh in on how does this plan work together for my family? And one of the last ways is there are annuities on the marketplace today. Annuities have become very popular in the last few years. They're called modern annuities, where they have a long-term care rider where they can increase the value that you can take out over time. So these are the 5 ways to pay. Now, as you're going through these 5 ways to pay, in my almost 30 years, this next year will be 30 years, and I know what you're thinking, there's no way that girl could be that old. Yeah, it's true. I have grandbabies too. I left the pictures out because my team made me take them out. But next year, if I come back to Big Iron, I'm taking the pictures. We're doing the pictures. Now I want to talk about 2 very important ones here. They're the most popular right now. You want to write down this information, or you want to make sure you get my slide deck from me afterwards, which we'd be happy to email you if you have information that you want to get more detailed on. So there are 2 on the screen that you see here. One is called a traditional long-term care policy. Traditional long-term care policies work like this. You purchase an insurance policy. You get it for a set amount, either daily or monthly, and that kicks in when you can't meet the terms of that policy, and these are called ADLs, Activities of Daily Living. So if you go to a nursing home, or an assisted living care facility, you want to understand when do they pay those things out. Many of the insurance folks that we work with in the industry don't always know the answers to those questions. So I'm going to talk about exactly what you need to have in an insurance review here later so that you make sure all the money that you're spending on these types of products over time actually goes to you and your family. Now, the first one is when we start talking about traditional long-term care insurance. If you purchase a traditional long-term care insurance policy and you're 55 or 60 years old today, you have that policy in place. Years ago, the United States government decided through Congress that they would reserve the right for the insurance companies to go back in and raise those premiums at will. Now, if you have an old grandfathered policy in place, those grandfathered contracts will allow you to keep that premium level till Jesus or the other guy takes you home. Okay, you get it? Jesus, other guy? Kind of funny. Okay, not here to convert you, just, speaking out who I am. Okay, so really important that you ask this question. When do they pay out? There's typically what we call an elimination period. It's 90 days, 90 days. And you want to look and you want to ask some questions. On the very next slide, I'm going to give you 4 very specific words you want to write down. Get your pens and paper ready, because I got them going for you, okay? So the second type of contract that we have is what is called a hybrid policy. It's a life insurance policy with a long-term care critical illness rider. How these policies work is you purchase a life insurance death benefit, say $500,000, $300,000, whatever the number is that you feel comfortable with, and if you end up needing it for nursing home long-term care events, once you can't meet 2 or more of your ADLs, what's an ADL? Activity of daily living. Once you can't meet 2 or more of your ADLs, activities of daily living, that's bathing yourself, using the toilet today, that's feeding yourself, transferring, that's getting in and out of bed today. As you're looking at that, one of the things that they're going to ask you is once you can't meet 2 or more of those ADLs and your doctor signs off on that, this policy kicks in. This policy kicks in and will allow you to spend down the insurance company's death benefit prior to you passing away. So if you have a $500,000 death benefit, now you have a $500,000 pool of cash that can be spent down to use for long-term care. Now, if you don't ever end up using it for long-term care, at that point there, you are good to go, because upon your passing, that will pass income tax free, life insurance passes income tax free to your beneficiaries. Life insurance passes income tax free to your beneficiaries. Now, why am I sharing that with you? Because I've had people for years and years and years purchase long-term care insurance, and then they're in a home for maybe a month or 2 or 3 months or 5 months, and they've paid in for years and years and years and years. And at the end of the day, they don't get anything back out of it, right? Because there's a 90-day elimination period, so you have to be in that home for 3 months in order for that policy even to kick in. Does that make sense? You have to be there for 3 months before it even kicks in. And you die, 6 months in, you got 3 months, and you've been paying on this thing for 10, 20, 30 years. Really important that you ask some questions about those policies. Now, I'm not here to sell you insurances. I am here as a professional speaker, and I'm an advisor to my clients nationwide. I advise teams, and I advise all sorts of groups like this that come together that say, what do we do? How do we protect our families from nursing home? How do we make sure that the lifetime of legacy that we've been trying to build actually goes to the people we want it to go to? Now, these are 2 of the tools that you can utilize to do that. Now, I want to talk a little bit about cost, because people say, well, geez, Marissa, it's expensive, and how do I do that? Well, I want to ask you about cost, because if it's $10,000 a month, $10,000 a month times 12 months is $120,000 per year. Yes? Basic math. Yes? If you're doing $120,000 per year and you're in a nursing home for 4 years or for 5 years, how much money have you spent? You're spending well over $500,000. When you purchase these types of policies, I'm not advocating for any one insurance company. My firm is a brokerage house, which means we do not work for an insurance company. We work for the clients. So when we go back through and we're doing insurance reviews, when we're doing recommendations, things like this that might work for your family, we're doing that based off of working for the client, not for an insurance company. The very vast majority of the insurance world works for an insurance company, does not work as a fiduciary for their clients. So very important question that you ask, who do you work for? Who do you work for? How do you get paid? Really important question. So when you start looking at rates and numbers here, and you start looking at $19,000 a year, people go, oh, Marissa, there's no way I'm going to spend $19,000 per year. Okay, I'll buy that, right? But if you're 60 years old and you're going to spend $19,000 per year, that's a lot of money. You want to make sure that there's a couple things. Number one, that this is permanent and the cost cannot increase. Number two, it pays out upon your death. And number three, it's when the cost of insurance is less than the payout, when the cost of insurance is less than what you get as the end death benefit, you win as a consumer. So you got to do the math to see, is this the right thing for me? You got to do the math. But it gives you a 2-for-1. So instead of buying a life insurance policy and a long-term care policy, you buy a 2-for-1, a twofer. You put it in the same contract. Now, these are the questions that I want you to write down. There are 4 words on the screen. Grab your pen out. Make sure you write these down, because if you are considering long-term care, if you're considering life insurance, if you're considering some of these strategies to protect your farm, especially if you've got a next generation coming into here, you want to understand the difference between an indemnity policy and a reimbursement policy. You want to understand the difference between calendar days and service days. Now, what's indemnity versus reimbursement? Very quickly, here we go. Indemnity is this. Each time my dad got a check in, and there's 2 different ways you can set this up. My dad had a reimbursement policy, so I had to, as his power of attorney, I had to pay the bill, then I had to submit a form to the insurance company, and then about 90 days from now, 90 days, no kidding, this happened every single month, for 5 years, 5 years I did this, 5 years. I had to pay the bill, take the form, submit the form, then go back and make sure that the insurance company paid my dad for 5 years, every single month. I did it well over 60 times. So I know this process really well. It's called the reimbursement policy. Now, if you have an indemnity policy, which my dad did not, because he bought it for a really nice insurance guy in his local town, which was great. I said, Dad, you do what you want to do. Totally cool. But he bought it from an insurance guy that didn't understand the difference between reimbursements and indemnity. So the indemnity policy, this one works, it costs a few dollars more per month. For him, it would have been about $6 more per month. But this policy, how this one works, is it takes those dollars and says, you're going to do one form at the front end, and then once a year you submit a form with your doctor that says, yep, they still need it. And the insurance company just starts sending those checks until they hear further, until the recheck a year later. Now, this is really important because an indemnity policy cuts out time and work for your family that is left doing this work for you. Now, the second one is what's called calendar days versus service days. The other thing that my dad had was he had service days, not calendar days. So he was receiving services 2 days a week. And he had a 90-day elimination period, which means 45 weeks later, Dad's policy finally paid out, not the 12 weeks later that he was expecting. Calendar days would have been 90 days. Service days is the number of days per week that you're receiving those services for. So really, really important that you know the difference between those. You are spending time, energy, and money on these 3 things, and you want to make sure your time, energy, and money is well used. Now, I'm going to talk a little bit about risk management. There's lots of different types of terms thrown around in agriculture about risk management, but the first thing I'm going to give you here is a little quiz. It's a risk management review. Again, this is inside this handy-dandy little downloadable notebook that you've got, and if you've got this with us today, you want to take this home. You want to fill this out with your spouse. You want to take a few minutes and ask these questions for each other. By the way, this is your guidebook of how do you plan going forward, and it's free today. So if you take this risk management review, it's going to ask you all sorts of questions about where are the areas that we're at risk, because there's all different areas. Long-term care and nursing home is one area that you're in risk, but there are other areas. There's a cost to your estate for probate. There's all these different predators of your estate. This is why we called the presentation Defending the Legacy, because there are predators out there that you need to defend the legacy from. There's the outlaws, okay? You get it? In-laws, outlaws. Okay. There's the people talking in your kid's ear that goes, no, you're not getting your fair share. Have you ever heard this? And you get farm kids and non-farm kids fighting about who's getting what and when and how and what's fair in the marketplace. Probate fees, transfer costs, long-term care expenses, medical expenses that people have. There's all sorts of predators of your estate. So this is where I talk about Insurance 101. Inside your planning folders, these are some of the things that we create for our clients today. We create a binder that looks like this, and you can do it digitally if you want. But we create a binder that looks like this, and inside this binder is all of the insurances. It's all of your estate plan, your will, your trust, your healthcare directive, your durable power of attorney, the copies of your deeds, the copies of your titles. I'm going to give you the exact checklist, by the way. At the very end of this presentation, you're going to get a full checklist that's going to help you go through and create your binder today. This will save you. I literally had an attorney call me from one of my offices in the local town and said, hey, can you stop giving out this information? Because my billable hours are going, right? They're going down every year. So I got this lawyer mad at me because at the end of the day, those clients were spending less dollars on probate, less dollars on legal fees because they were planned and they had everything all in one spot. So insurance is one of those areas where you want to make sure you have it all in one spot. Life insurance, long-term care, disability. What happens if you get sick or hurt? And I'm going to talk with the young farmers at this point. If you've got a next generation farmer today and they get sick or hurt for any period of time, and they're your hands and feet out in the fields, right? They're your hands and feet out in the barns, out in the bin. When you're having this conversation today, it's a double whammy for farm families. Because if we get sick or hurt, if we have a cancer, we have a stroke, we have a major farm accident today, who's going to take over and do the laborer side of this position? So disability is a big issue for farmers and ranchers, and there's great, great organizations that will show up. Farm Rescue, a little shout out for those guys today. Farm Rescue, these are the hands and feet, right? They show up when everything's bad. They show up when things have gone to pot. They are you. They're the neighbors that say, I'm going to volunteer to help my neighbors today. But there are also things that you can do to protect your family. So talk a little bit about quickly on life insurance. There's two different types. There's permanent policies and term insurance policies. Temporary, permanent versus temporary insurance policies. You want to understand which type you have, which type you own, and there's some questions that you want to ask. The first one is this: who owns the policy? Who owns the policy? If you're buying these types of policies, this is important if you've got cash value in them, because if you do and you go into a nursing home and you're planning on using this for your estate plan, which I'm going to talk about later, because there's a lot of estate planners that call themselves estate planners. They are not. What they do is they sell you big insurance policies and they say, hey, just buy some insurance, build some cash, you'll be good. And you go, okay, because I don't know, I've never done this before, and you're an estate planner. If you go into a nursing home with these policies and you own the policy and there's cash value inside of that, they will go after that conversation and ask you to put it down as a list of assets. They can make you surrender those policies to pay for the insurance, pay for the benefits that you're receiving from the nursing home. Who owns the policy? Who's the beneficiary of it? Where will it go? You want to double check these things. I've seen policies where an ex-spouse, an ex-husband, an ex-wife, an ex of any type is listed on there. People don't get happy about that if you die and you leave it to your ex-spouse, right? It's not a good day. So there are multiple other questions that I ask when it comes to those life insurance policies. You know, costs of insurance, have we got those things in place for your risk management review? One of the things I ask in risk management reviews is, when's the last time that you received an illustration going to age 100 to make sure that that policy is going to be in place when you want it or need it, right? The other questions that I ask when it comes to this is, why did I purchase that policy? What's the need? What's the benefit of it for today? I've talked a lot about risk management and insurances today, but this is an area where I call it the fleecing of America. People spend thousands and thousands and thousands of dollars every year on insurances that don't pay out because they haven't done what I call the next step of this, which is do a review. Make sure that you've got those questions in place. One of the things that you will have coming out of today's session is this. If you sat through this session, whether online or in person today, we will do a free insurance review for us, for your family, and you'll get a full report from us to you, which will give you the peace of mind at night to say, yes, this policy will be in place. Yes, I spent time, energy, and money on it, and I know that it's going to go to who I want it to go to down the road. Really, really important that you know why you bought it, what the purpose is, how much do you have, when will it pay out, and will it pay out? Okay? Another area that I want to talk a little bit about is, as we get into, let me go back here, is strategies for creating in place structures for your farm or ranch. Just today at the booth, my dear friend and I, Dave Falk, I've got my entire team here from Minot, Bismarck, Jamestown, the physical locations that we have here in North Dakota. Just today, we're sitting at the booth talking with someone about how they had structured their triple LP and they had structured their trust and they had structured some of these things. And she said, well, yeah, it's all protected from long-term care. And I said, well, we should probably talk about that. There's some key questions, and I don't have time to go into those key questions today. This is what I teach in a full-day seminar in our succession planning school that we do, which I think we'll be hosting here in January. But these are important that you understand. I'm scheduling this as a Schedule F sole proprietor today. Am I set up as an LLC, manager managed, or member managed? I'm going to talk about that in just a moment. How am I structured as an S Corp, a C Corp? Now people say, well, you can't do an LLC. You can't do those things because it's corporate farming. Well, no, it's not corporate farming. You're not a corporation. You're a family farming under a company in the state of North Dakota. So they're fully legal in the state of North Dakota. Other states have different rules. So depending on where you're watching this from, I'm speaking directly to North Dakota at this point. Limited liability companies and LLPs, limited liability partnerships today. I want to talk about some of the benefits that you might want to consider for your agriculture-based business today. One of the things that I share there is you can structure it so you can protect it in the event of a lawsuit. You can structure it so that you can protect it in the event that something goes south in your family. Another area that you can utilize these structures for is gifting over time. So instead of gifting a quarter of land, you gift shares in the LLC that holds all the land today. You can structure what we call buy-sell agreements, and there are the big five. This is not in your presentation today, but I'm going to give it to you really quickly. Here they are, the big five. This is for buy-sell agreements in the event of a death, in the event of a divorce, in the event of a disability, in the event of a disagreement amongst the business partners, or I just want out, and we call that retirement. I just want out. We want to retire. So I have many, many families that our team works with. Nick and Dave and Troy and Adam and Megan and Jay, all of our folks come together, and they're talking with multi-generational families, but sometimes there's brothers and sisters and family members and cousins that are farming together. And when you're doing that today, we want to make sure that you've got some structures in place in the event that somebody gets sick or hurt or has any of those big five. We call those a buy-sell agreement. You can talk with your team about that, and that's why, again, you want to bring those people around the table together. Now, if you are just talking to one person at one time and they are not bringing your team together, I can promise you that there is holes in your plan. I can promise you there's holes in your plan, because it's much like walking into that operating room at Mayo Clinic like I talked about before, that we must look at how the whole picture fits together. So when you look at this today, one item that I had not mentioned on the previous slide was tax benefits. There's a massive tax benefit that you could get if you're structuring that properly. If you're a sole provider, sole prop today, Schedule F person today, and you have that in place, great. But let me just introduce something new to you that you might want to consider. If you transferred that land into an LLP or an LLC today, a limited liability company or a limited liability partnership today, you as an operator over here, as a sole proprietor Schedule F operator, can rent land from people. Yes, you might be renting from your neighbors right now. As you're renting from those neighbors, you put that Schedule F sole proprietorship over here, you put the land into an LLC, and you can rent your land to your operation. Now, why would you do that today? Why? Well, because as a Schedule F sole proprietor today, you pay this groovy little thing, groovy, old school word, you pay this groovy thing called an SE tax, self-employment tax, at 15.3% today. So you're going to pay, not only you're going to pay income tax on whatever your active operation made. So if you made $100,000 in your, and this gives you different numbers than that, but if you made $100,000 in your active operation today, and it was $100,000 of net income to your Schedule F, You're going to pay 15.3% self-employment tax, plus you're going to pay income tax on that money. So if you're doing the math here with me, 22% plus 15%, right? We're looking at 39% is what you're going to pay, almost 39% to the United States government, to the IRS today. If I move even $50,000 of that over into a cash rent, and I rent that land to my operation, it becomes a deduction to my operation, it becomes income over here, but I can avoid paying the 15.3% self-employment tax. Now on $50,000 at 15%, that is $7,500 a year of cash. 10 years of this, 7,500 bucks. Right? That's 75,000. Now it's 150,000. I'm not even talking about the time value of money. So there's some huge tax benefits as well as some legal structure benefits that you can use today to protect you and your family. Inside of this planning packet I have for you here today, I have a set that's called How the Farmer Uses an LLC, and it's going to take you through some of those structural options that you might want to consider for your farm or ranch today. You'll find that in the planning packet. If you have questions about the setup or the process of that, we are around for the next 3 days for the show, but you can also reach out. You can email our office. We're happy to take questions over the phone. We're not going to charge you for a Q&A over the phone. We just want to make sure that people get good information and they can bring it back to their advisors today to help them make good financial decisions for the farm. Now, what's the exit strategy planning process look like? Now, this can be very difficult because we don't really know the steps in that process today. And I spent a lot of time talking through how do we help people go through step 1, step 2, step 3 of your operation and your planning today. For lack of time, as I take you through exit strategies, I'm not going to go through each slide with you today. But please keep in mind as you're going through some of this information, setting up buy-sell agreements, setting up exit strategy plans for how do I take my farm to the next generation. This is a big one in tax strategies. I'm going to take you through a couple of tax strategies for next generation and no next generation planning a little bit later on in the presentation. But there's a process, and we call this A to Z of transition planning, of succession planning. For almost 30 years, my team has come together with your local accountants, local attorney, local financial people, and we sit around that table like I talked about, and the first steps in this A to Z, this is a worksheet that we have inside that planning packet for you today, and it's going to give you step by step by step, along with a check the box, where you can take it back to your planning team. Now, if they've never done that before, you probably want to give us a call, because at the end of the day, this is a process, and it's much like heart surgery. You only got really one chance on that table, right? You want to make sure you got a good cardiologist. I'm not going to call Joe, even though Joe has been my friend as a physician, as a family doctor in my town for the last 30 years. I'm not going to say to Joe, hey, Joe, let's give her a whirl in the back office because I know you watched a YouTube video on this, right? I'm going to say to Joe, hey, can you refer me to a specialist to make sure that when I get my ticker cleaned out, we're good to go? This is the same process that we have. So there's a couple of first steps that I'm going to give you. The first one is you want to look at asset values, and you want to put those into two different categories. Land in one, operations in the other. Why? Because they are taxed differently. And a good, proper plan is going to have your taxation plan as part of it. What happens if I buy, sell, change, rent, move, gift? What happens if I do those things? Then from there, you want to look at what are my options? Do I have a next generation farmer? No next generation farmer? And maybe that next generation farmer isn't exactly the next generation. Maybe it's your grandkids. And you see them coming up through the ranks and you say, hey, we got to figure out an operational plan here to make sure it's not just my generation getting an income stream, but it's my kids and my grandkids off that land. Many times I'm seeing 2 and 3 and 4 generations being supported on that land today, on those operations today. Then from there, once we've got it figured out, what are we going to do with the land and what are we going to do with the operation? We have to figure out where mom and dad's income going to come from. And it's not what the kids think you should live off of, it's what you think you should live off of. Because I get that a lot. Sometimes I get entitled next generations. And sometimes they think Grandpa and Grandma you should be able to wake it off of $35,000 a year. Come on now, you're going to get a little Social Security, you'll be fine. That's sarcasm, by the way. The question is, how much do you need? What does it look like? How much cash flow is it going to take to support you in retirement? And then the next generation and the next generation. So you got to have a place for where do you put that cash? Anybody watching the stock market today? Anybody watching the stock market? It's all over the place. We're doing this. It's up, it's down, it's up, it's down. It is manic when you look at the numbers that we're seeing every single day for people's retirement plans. So it's very, very important that we look at what are your 3 buckets when you're hitting retirement. I'm going to take you through retirement planning strategies. And why we're going to talk about that is because we need to find out, number one, where are you at right now? What are your sources of income for retirement? Where will those come from? Cash rent, buyouts, savings and investments, retirement plans that you've done today. That whole transition plan leads to how do we move it through the generations, but how do we make sure at the end of the day, everybody's got the income they need to make that work. Now, I always start with retirement planning and I talk about your bucket list because this is the very hardest thing for farmers and ranchers to do, right here. It's give up control, and I'm not asking you to give up control, so take a deep breath. But it's what will I do if I don't do this? What will I do if I don't go to the field every day? What will I do if I don't go to the bins or the barns every day? What will I do? And I call that a bucket list. There was an old movie on this several years ago. They called it the bucket list, and the whole point behind the movie was, what do I want to do before I kick the bucket? All the stuff I haven't done. I was sitting with my friend Dave today at the table. We were eating some of the yummy concession stand food today. And we were talking a little bit about retirement and about some of the strategies that people could use to make sure that they've got income in place. But it's far more than income. Dave said, I don't fish, I don't hunt, I don't golf, I'm not going to go to Arizona. I want to watch my grandkids play, basketball and football and be involved in that. I go to the lake in the summer sometimes, but I don't have a lot of those extra hobbies because I've been working my whole life. And people say, well, you should just retire and go enjoy yourself and relax a little. Well, what the heck? You got a whole next generation that needs you here. And they need your advice. And they need your mentorship, is what we call that in the marketplace. They need your help. Because if they don't know how to build it, and we just give it, they don't know how to keep it when the hard times hit. The reality is, I love my dad. And we've had many conversations about this over the year. But he didn't know how to keep it when the hard times hit. He didn't know what to do. And there was a lot of guys that were farming during the late 80s that lost their farms and ranches. But Grandpa had already gotten sick, and then he said, hey, Junior, come back and take it over. He didn't have any mentorship. He didn't have any help. He didn't know how to be a good steward of what he had. And they had already took over what I'd call a sinking ship because we had 18% interest rates then. And so when you look at what do you want to do and how do you want to pass those reins over time? Please hear me, next generation, please hear me. We need you. We need you. We need you to speak life into that next generation. We need you to communicate, hey, you may not be doing everything right today, but you're doing some things right, you're doing good. And the next generation, you need to ask for help, right? That's hard to do. And the senior generation, we need you to be the chief encouragement officer. You are now the CEO of that farm. And we need you to be the chief encouragement officer because we have a whole set of generations in North Dakota and around my states that I'm looking at, Minnesota, Iowa, South Dakota, Montana, all of these states today that currently do not have a chief encouragement officer. They got somebody looking at them and saying, you're doing this wrong, and you're doing this wrong, and you're doing this wrong. We need to do better in the area of communication. There's a retirement timeline. So I'm going to talk to the 20s and the 30s and the 40s and the 50s and the 60s. What you slay in your 20s and 30s and 40s is what you will eat when you're 50, 60, and 70, and later in life. So there's a retirement process that we take you through. Now, there's a time value of money, and we're going to call this the rule of 72, but before we get into that, I want to do one thing on my whiteboard here for you. So hopefully you can see this online as I'm going through here, but this is a tax planning strategy. It is not in your presentation. It is not going to be here, so you want to write this one down. So here's one of the things that I ask farmers and ranchers every single day. I teach workshops like this all over the nation today, and the first one is, what do I do if I've got no next generation, no next gen? Well, you've got a couple of options, and I want to talk about the tax planning benefits of this because I'm going to go right into a couple of slides here that are going to be really, really important for you. So if you've got land or you've got an operation over here, and I'm going to talk specifically, in the previous presentations, they were talking about capital gains tax. They were talking about 15% and 20%, depending on what tax bracket you were in. I'm a tax girl. One of my favorite things in the world to do at night is to read through and scroll Tax Planning 101. I read through the codes, the Internal Revenue Code. I love it. It is my favorite thing. I have a good time doing it. I love to read like tax law. I love it. And people go, this is why that girl can't get a date. It's very simple, it's very easy, but I love it, and I love to find all the different options that are available. So the first one is land is taxed at that capital gains tax rate. But if you sell your operation, I'm talking about your machinery, your equipment today, your inventory today, if you sell your operation today, that's taxed at your income tax rate. Income tax rate. So depending on what you sell that for right now, by the way, here's the question for you. Do you believe the taxes are going down or going up? Up, said by everyone with a brain today. Yes. Good job. You all passed the IQ test. See Danielle at the back. She'll give you some chocolates on the way out. Well done. See, we know, all of you that said yes, we know that we have a $1 trillion deficit today. We owe millions and millions of dollars, but it used to be millions. Now it's trillions and trillions of dollars to pay for the CARES Act, now to pay for colleges, now to pay for people staying at home from work for the last couple of years after COVID. We have a $1 trillion war on terrorism worldwide. And you're going, wow, Pollyanna, thanks for coming to work today. But here's the thing. They're coming after our tax dollars, and we need to fight it with good, proper information. It is why I'm here today. It's why I'm so, you can see my veins start popping out of my face every time I have this conversation. Because we need to get the right information into the hands of the people like you and I. So, you can sell that today, and let's say you've got $2 million worth of equipment and inventory today. You're going to get taxed on that, and for sake of simplicity today, I know this is not an exact number. I can get you the exact number on a spreadsheet, but you're going to give roughly 40% of that, or $800,000, to the IRS to pay the tax bill on that. The other option is there is a form of a trust. We're going to call that a CRT. There's many different forms of this, but it's called a charitable trust. If I transfer that operation into the charitable trust and I sell it, now this is for no next generation. If I transfer it into here and I sell it and I have an auction today, if I sell it outside of here and do an auction, it's going to be taxed at roughly 40%. I'm going to give $800,000 away. If I sell it inside of a trust today, it's going to, because it's a charitable trust, it is not taxed at the time of the sale. It's taxed when you take out any income stream that comes out of here. So when you pull out, if you put in $2 million, no taxation, I sell the asset, I have $2 million sitting in that account, and I say, hey, I want to pull off 5% a year till Jesus takes me home. 5% a year is $100,000 a year, right? So I'm going to pull off $100,000 a year. Now, if I want to pull more than that, I can. If I want to pull less than that, I can. That's called a NIMCRUT. But if I pull off that $100,000 per year, I'm only taxed on the $100,000 a year, which is roughly right around 18% is what you're going to pay. Now, which tax, by the way, this is an IQ question. Are you ready? Which would you rather pay? 18%, 15 to 18%, or 40% to the IRS this year? Please say 18. Yes. Okay, so when I look at this today, I pay over time as opposed to one lump sum, and it gets me a higher level of income. Now, if I want to pull out this income stream, I can also leave it on to the next generation over time as well. So I can leave this for up to 20 years. So if I say, hey, me and my spouse are going to take that income stream for the rest of our lives, and then at the end of our lives, up to 20 years, there's going to be an additional income stream that can go to the kids. We have some specialists in the room that can talk through that. One of the guys on my team, his name is Nick Mock. You're going to want to talk to this guy. You want to ask that question, hey, Nick, run me my numbers. Show me, how would that work if we did this? The bottom line is this. Over here, if I pay the $800,000 to the government, I have $1.2 million left out of that $2 million. Now, which bucket would you rather pull from? 1.2 million or 2 million? If you're going to take 5% a year, like I did over here, 5% a year, that's a $60,000 a year income or a $100,000 a year income. Which check would you rather have me write? Now, this is extremely important because these are just some of the options that are available to you. And the reason I showed you the rule of 72 right now is because every $100,000 decision you make is $1 million decision. It's not a $100,000 decision, it's $1 million decision. So tax planning rules, let me give you a couple little sections of this that are going to be really important. In the United States today, there are 2 sets of tax rules. And people say, well, no, there isn't, Marissa. There's only one set. It's called the code. And I say, yeah, except for the 2 different decisions are this. It's one for the informed, one for the uninformed. Both are legal in the United States today. A couple of things for tax planning strategies. I'm going to blow through a lot of this in the next few minutes, but I want to help you really understand some of the retirement planning and sources of income that you have available to you. There's a section in here that's going to talk about the different types of benefit plans that you have under the code. Now, when you look at your money today, when you're investing those dollars, let me give you Investing 101 in about 2 minutes. Are you ready? Investing 101. You must ask the questions to your investment people. How do you get paid? Are you a fiduciary? Do you work for me or do you work for a commission? Really important question. Over 90% of what we have in this tri-state area are commission-based salespeople. They work for a company. They get a commission if they sell you a product. So there's 2 different ways that you can invest your money today. One is called retail, the other one is called institutional. Retail, you pay a commission or a sales fee, a sales charge to you to pay for that transaction. Institutional investing, you invest like large, wealthy institutions. It's called the affluent investing way, and it's called institutional for a reason because you pay a flat management fee. So if you go to a local hospital today, those hospitals come together and they take their 5,000 employees and they package all that money and they bring it to an institutional investor and they say, no, you're not going to get paid on each transaction. We're going to get paid 1 percentage fee per year, and you become a partner with them. So you keep 99% and they take 1%. That's institutional investing. Retail investing, you could be paying upwards of 4, 5, 6% almost in investment fees and expenses. Well, as I shared with you earlier, rule of 72 on here, every year that you wait and every percentage that you don't earn on that money today is thousands and thousands of dollars to you over time. So ask the question, how do you get paid? The tax rates are also inside of your planning packet. I'm not going to spend any time on that. You got questions this year. This is why we've got specialists on the other end of that line, on the other end of that conversation for you to say, hey, here's some ideas that you can bring back to your local accountant today. 2 of those I'm going to give you right now. Most important things, 9 out of 10 farmers and ranchers I see every single day with my team do not have these 2 things in place, and yet they are the biggest options for you in the tax code right now to save money today and take back more of what you were giving to the IRS each year. The first one is called a defined contribution plan. The second one is called a defined benefit plan. If you have grain sitting in the bins, if you've got assets today that you say, hey, I'm going to retire in the next 5 to 10 years, and you don't know how to get rid of it without paying tax on it today, because when you sell that grain, it now is taxable income to you, yes? Yes. When you sell that grain, it's now taxable income to you. There's a line on the tax return today. Let me give you the line really quickly. Here it is. And I'm going to come back to that page in just a second. Here's the line. Write it down. You got to have this before you leave. You want to make sure that you get this slide. On your personal 1040, on page 2, line 16, on Schedule 1, Page 2, line 16, there's a line that says qualified plans. These things that I'm giving you right here are called qualified plans. It's traditional IRAs, it's 401ks, it's your SEP. 99% of accountants know how to use a SEP, but they don't know how to use a solo K or a defined benefit plan. There's a couple of different bells and whistles that you can have, but if you want to write off a couple $100,000 today, and you want to do that over time, over the next few years as an exit strategy, so you build up a big pool of cash that you can use for retirement, this is the exact line that we're using and exactly how we're planning with your team. Solo Ks, same thing. You could put $60,000 a year this year and never do it again past that if you didn't want to. There are two different comparisons here that show the difference between a SEP and a solo K. You can put substantially more into that. Now, part of what we've got for you today is as you're leaving, as you're on your way out, we have a Get Started Planning Kit that's going to help you take through this information that we're talking about right now. So you want to hit our folks on the way out and make sure you get a Get Started Planning Kit. You don't have to use it with us, but it helps you get started with whomever you're doing your planning with. Really just taking people through the different, putting your money to work when we start talking about this retail versus institutional planning. It's extremely important that you ask those questions. How do I get paid? And how do I make that money work for you? Now, we're at the very end here. I know we're running out of time, so I'm going to hit this very quickly. Estate Planning Hacks 101, there's an estate planning assessment for you inside of here. How much time do I have left? Okay, so estate equalization, there's some things that we talk about, fair versus legal, fair versus when I begin to talk about fair versus equal today, there are 4 estate planning tools. Everybody who does estate planning knows the answers to these, right? It's wills, trust, healthcare directives, durable power of attorneys, revocable trust, irrevocable trust. There's different options for you on the marketplace. But I want to share with you today, so important that we have these things put in place, because I've had family members that do not speak to each other past mom and dad's death, and you can be the change agent here. You can be the decision maker of why your family would come together. So there are different types of tools that you can use, revocable and irrevocable trusts, wills. All a will says is this: when I pass on, here's who gets my things. Who, what, when, and where. So there's a few options in here for planning for trusts. And when you compare the two between a will and a trust, wills go outright, they're going to give those assets outright, and a trust gets handled with care from the standpoint that they're going to get it in trust over time, and if it's done properly, it can protect you from lawsuits, bankruptcies, and divorce. We also have quitclaim deeds in North Dakota. There are other states that are represented here, so I don't want to go into this too much, but this is something you have questions on that. Our folks can handle that at the back as well. When we start talking about these estate planning hacks, there are things, this one list here, inside of your planning packets, this will save you thousands and thousands and thousands of dollars as you go forward in your planning. So you want to make sure you get your estate planning hacks in place. And everything I talked about putting into that binder to make sure your family saved those dollars down the road is this. This is it. This is the exact list. You put it in here and we just start filling it out and putting those documents in order. If you do this, you can help them organize and plan for the future. I always ask you before I leave, what's your plan? What does that look like? Because the key to this is you get it written down. You put it in writing and you work through it with your team. Who do you know that they need to call? This is another list that's inside your planning packet. Who are the people that you trust right now to help them make decisions? And the next step from there is, are you overwhelmed, right? Most people are. And so we want to help you develop a plan, implement that plan, monitor that plan over time. Our team is here to help serve you. After almost 30 years, Freedom Financial Group has been a locally owned, North Dakota-based company born from a little girl on a farm that watched her granddaddy cry. And at the end of the day, this is the heart of our team. The heart of our team is to serve you. So I want to say thank you so much for being with us today. If you have any questions, I'll be around. I appreciate your time. Many blessings to you and your family on this journey. It is not easy, it is hard, but you can do it. You can be the one to make sure that that legacy continues. So thanks for being with us today. Have a good day.
Higher yields require high-performance crop nutrition. Through fusion technology, MicroEssentials is designed to increase nutrient uptake throughout the growing cycle. The unique chemical composition of MicroEssentials creates an acid zone around each granule. Lowering the pH promotes the formation of dihydrogen orthophosphate, a more readily available form of phosphate, resulting in increased nutrient uptake. With MicroEssentials SZ, plants more efficiently take up zinc because each nutritionally balanced granule delivers zinc evenly across the field. MicroEssentials also contains small elemental sulfur particles designed for faster oxidation to sulfate and increased uptake. The proof is in the performance. Research shows that plants take up nutrients more efficiently with MicroEssentials compared to traditional fertilizer blends, resulting in higher yields and higher profitability.